Hi, this is Erin and Simon with Assets and Arbitrage. Today we have a fantastic show for you guys. CEO Andy Schectman from Miles and Franklin has returned. We also like to call you the great macroeconomist because
Yeah.
you keep us up to date on all of the things going on in the global economy.
Yeah, so we just wanted to we have a Q&A. We have some people who are going to join us. So we'll start with some
Fundamentals.
fundamental things. So I've been I always follow you. I've seen you making your rounds at with Arcadia Economics. Shout out to Chris Marcus. And you had talked about this being, as far as silver, a generational opportunity to purchase silver. So could you go into that?
Sure. First of all, thank you for having me. It's good to be back. I appreciate your kind words. When I look at the environment, you guys, that we find ourselves in right now, it's been one of, if I had to define what is so unusual, where is the distortion, what is it a result of? The distortion that we see all around us, in my opinion, is a reflection or a manifestation of suppression of interest rates. And when you suppress interest rates for as long as the West has and make money so abundantly easy, especially for those who don't need it, you create great misallocations of capital and resources and distortions in asset prices, where over the last several years, we've seen trillions of dollars being created, more money in the last 3 years than in the preceding history of the country prior. $6 trillion were printed out of nowhere just since Biden took office. And a lot of that money went into assets where hedge funds could borrow money at next to nothing and billions of dollars and pump it into stocks and bonds and real estate and cryptocurrencies and make a fortune, pay off those loans with no problems whatsoever. Or corporations could borrow money in the open market at next to nothing, go in and buy back their shares in the open market, rather borrow money from the Fed or from a bank at next to nothing, and then go in and buy their shares in the open market, which inflates the value of their stock price, enriches them, gives them huge bonuses, but doesn't do anything to the bottom line. It doesn't help in productivity or doesn't help in the end product that is being made by this company. In fact, it actually takes away from it because the money is not reinvested in the corporation. It's just used to buy shares back, which decreases the float, as it's called. There's less shares out there, so the price goes up. It's illusionary. And what we've seen over the last several years is a difficulty in finding price discovery in just about any asset that's been blown sky high. The inverse of that has been the suppression of the precious metal market, because gold and silver are not commodities as they want you to believe. What gold and silver is money. And it is a reflection, or a opposite reflection, if you will, to the value of the whole Western system. And as gold and silver rise in value, it speaks to the weakness or the frailty of the dollar and the Western system. And so precious metals have been suppressed unjustifiably, as traditional assets have been inflated unjustifiably. And when we look at a historical relationship between gold and silver, which goes back 5,000 years, in a geological respect and in a price relationship respect, silver, especially silver, represents maybe the most undervalued asset on the planet in all of its relationships with gold. And there are very few assets that have so much utility, in fact, a duality in its utility, where it's experienced and gone through a renaissance in monetary demand, and and a massive expansion in industrial demand into green and green applications, digital applications. The need for silver is extensive. And when you talk about all of the green and digital applications around the globe that need silver, the likelihood of being able to suppress prices at this level when we are running continual deficits in demand versus supply, and the uses for silver continue to expand in the green and digital applications, it represents a very unique opportunity in that, number one, geologically and in its price relationship for 5,000 years, silver is way, way undervalued. And we can get into that, of course, I can give you specifics. But when you talk about an asset that has so many uses, both monetarily and industrially, it's an asset that you must have to make your iPhone or your iPad or your solar panel or anything that conducts electricity, anything that's electronic has a little bit of silver in the motherboard. And the interesting thing about silver is that because it's used in such small amounts in so many things, it doesn't get recycled. And so much of the things that have been used in industry over the last 80 years are in landfills, never to be recaptured or recycled. Whereas the majority of all the gold that's ever been mined since Genesis is still on the planet, whether it be in the form of jewelry or coins or bars or whatnot. It makes sense to recycle it out of any industrial applications because of its cost, where silver doesn't. But the expansion into a world that is going green and battery powered vehicles and solar panels and whatnot, the need for silver is extraordinary. And what we've seen is its geologic footprint cut by over 50%. In other words, for 5,000 years, 1 ounce of silver was equal to 1 ounce of gold was equal to 16 ounces of silver. That's the geologic footprint. And that geologic footprint followed it all the way to, you go back to Sir Isaac Newton when he was developing the relationship between gold and silver in the UK Mint. 16 ounces of silver was worth 1 ounce of gold. This geologic ratio and this price ratio has been with us for the majority of human history. When we get to the Industrial Revolution, the relationship changed, and it had a lot to do with logistics, and where it went from 16 to 1 to somewhere around 75 to 1. President Roosevelt here behind me had something to do with that. But the bottom line is that the geologic footprint for 5,000 years has been 16 to 1 until right about now, where what's coming out of the ground is 7 ounces of silver for every 1 ounce of gold. The geologic ratio has been halved. And now it is becoming scarcer and scarcer and scarcer because it's found in nature in a form called epithermal, which is very near the surface. So the big deposits were found decades ago. And so you're dealing with a geologic footprint that's been cut in half and an industrial demand that has increased tremendously with a green and digital applications that are expanding in use cases every day, on top of a global recognition of its use as a monetary asset. And so you put it all together, you have diminished supply, increased demand, and an asset that has been suppressed for so long that it is trading at half of its all-time high when every other asset on the planet nearly has been blown to sky-high valuations through suppression of interest rates. But the canary in the mine shaft, gold and silver, have not. And in an environment where the largest inventories in the world, that being the London Metals Exchange and the COMEX market, are being bled dry by the most sophisticated investors on the planet, it betrays the price and the rhetoric that we are seeing. In other words, to pull metal off the COMEX and off the LME, the London Metals Exchange, you have to be an incredibly sophisticated and very wealthy investor. It is not an easy thing to do. It's not like calling me and buying $10,000 worth of silver. It is very in-depth and involved, and you need to know what you're doing. And then when you take a contract of silver, which is 5 1,000-ounce bars, or a gold contract, which is 1 100-ounce gold bar, and we'll talk about what's been happening lately on COMEX, where are you going to put it? You got 350 pounds in 5 bars, bars the size of a loaf of bread. What are you going to do with it? These bars are leaving the exchanges. The massive drawdown are leaving the exchanges where they lose all their industrial liquidity. In other words, the reason to keep your bars inside the COMEX ecosystem, if you own a lot of 1,000-ounce bars, would be the industrial liquidity, where Elon Musk may say, hey, I'm going to pay a $25 premium for every ounce of silver people want to sell me in 1,000-ounce bars. And when we see massive, massive, massive deliveries off of both the LME and the COMEX that are leaving the ecosystem, they lose all industrial liquidity. In other words, it's a one-way ticket, and most of it's going eastward, where India has imported 300 million ounces in 2022, and there's only 33 million ounces backing the entire registered category of the COMEX right now. So yeah, it is and that's the price setting mechanism of the West. So yeah, it's getting real, where it represents in every metric an amazing value, that of a generation where the need is increasing, the demand is increasing, the supply is decreasing, and the price is 1/2 of its all-time high, when everything else seems to be many multiples of its previous all-time high. And it is for that reason, and others, that I look at it truly, honestly, without trying to be trite, as the value of a generation. And I mean that to my soul.
Definitely. Oh, most definitely. Yeah, go ahead.
So, one of the things that I've noticed, a lot of our audience members they're like digital nomads. So they're contractors, some of them are employees. And I noticed that like the average person is used to traditional investing. So you work for a corporation offers you a 401k. And just for example, my 401k only did a 3.5% return.
Yes, yes.
So one of the things I would like for you to discuss is, because the idea of purchasing silver rounds or gold rounds may be like, okay, what are we doing? If you could just kind of explain to someone new the benefits of not walking away from your 401k, but in addition to thinking about getting their hands on some silver rounds, starting their silver portfolio, how it could benefit them, their family, and generations to come.
Yeah, so a 401k offers you limited choices within what to invest in. It's like a group of funds. If you no longer work at that company, holding a 401k is ridiculous. And no matter what, you should move it into a self-directed IRA, whatever you decide to invest it in. And a self-directed IRA is just what it sounds like. You have the ability to self-direct where you're putting the money. Whereas a 401k is like a mutual fund. There are baskets that you can invest in, whether it be interest rates or high risk or low risk or a money market or whatever. So, I think that most people's wealth is holed up within their retirement accounts. In a self-directed IRA, you do have the ability to own physical precious metals, not within a company-sponsored 401k. The custodian will never allow it.
Right.
99% of the time, they wouldn't. What gold and silver are to me is wealth. It's not an investment. I started this company with my father on a wing and a prayer 33 years ago. My dad's middle name is Franklin, or Miles, I'm sorry, and his best friend who loaned us $60,000, his middle name was Franklin. My parents sold their life insurance policies. We started in a one-room office the size of a closet with a loan, the proceeds of a cashed out insurance policy, and a hope. And here we are 33 years later, having eclipsed 8 billion in sales without a customer complaint. I'm wholly proud of where we have come from and who we were at the beginning. And I would like to say I'm the same person. The only rule that my father said when I was 19 years old, starting this company, is that I'll buy something every 2 weeks or he'll fire me. Other than that, no rules. All right, cool. I can deal with that, Dad. And although he's been retired for 20 years, he's still my sounding board. He won't fire me anymore, but I've honored my word to him. And for 33 years, every 2 weeks, I have never, not once, missed a 2-week period where I did not add to my portfolio of physical metals. To me, it is not an investment. It is wealth. It is wealth that I hope I never need to use. Now, a lot of people would interpret that as being for an emergency. Okay, great. It's there for an emergency, but it could be an opportunity as well. And if not, I give it to my kids someday, knowing that long after the money in my wallet is hanging from a frame in the Smithsonian as an example of what used to be, that gold and silver will be immutable wealth as they have been for 5,000 years. To me, it is wealth. And it is the only wealth in terms of assets, to my mind, that are not simultaneously someone else's liability with tremendous liquidity. Now, you could say a diamond is not someone else's liability. True that. But, who knows what the hell a diamond is worth? Take away the GIA certificate. Now what's it worth? And how do you know it's not fake? How do you know it's not lab made? Blah, blah, blah. With a gold coin or a silver coin, it doesn't matter where you are in the world, what language is spoken, what nationality you're speaking to. Gold and silver are universal. Man has been in search of gold for all of time. It goes all the way back to biblical times. So gold and silver are immutable wealth that transcends all race, religion, creed, language, you name it. It is immutable wealth, and will be long after I'm gone, and my great-great-grandchildren hopefully are using what was passed on to them. To me, it is wealth. You own enough of it, you'll be wealthy. But I don't sell gold and silver to anyone to get wealthy. Gold and silver to me are the bedrock of everything else you do financially. And it becomes much easier not only to understand what it represents, but to deal with the ups and downs and realize that anyone of nobility, going back to biblical times, princes, kings, queens, pharaohs, emperors, and now central banks, what's the only asset that every central bank owns? Gold. And so gold and silver are pure wealth. They are money. And that's the way that I look at them. You don't buy them to get wealthy. You buy them because they are wealth.
They are wealth. Yes, indeed. Okay, so, on this channel, Andy, we talk a lot about cryptocurrency, mostly Bitcoin. And, famously, some of these famous Bitcoiners, if you will, like Michael Saylor, Max Kaiser, Robert Breedlove, they claim Bitcoin to be digital gold or gold 2.0. How would you see that as far as I know, because they use the properties of sound money to back that up. How would you see that?
Gold has never fallen by 80% once ever in history. Never. Gold, Bitcoin is not digital gold. Bitcoin is a speculative investment that can make you very wealthy and can also collapse. Bitcoin to me is not. Yes, I understand because of the limited amount, 21 million or whatnot. I get it. It's not digital gold. That's what they want you to believe. To me, it is a speculative investment, and it has properties that would be reminiscent of what you could find in gold. But to me, they're completely different. And I think when you see an asset that can go from 65,000 to 16,000 or whatnot in a very short period of time, that is not digital gold. That is a speculation. And this is gonna. I got a lot of crap for this, but I got a lot of laughs also. I was asked this question on a Twitter space the other day. And please excuse me for, I'm not trying to be vulgar, but the funny thing was after a long discussion, I said, yeah, well, can't even believe I'm gonna say this to you. You can't pour Bitcoin on your naked wife's body and, cover your wife with gold coins you can do, but you can't do it with Bitcoin. Look, to me, Bitcoin I'm not a Bitcoin basher, but I do not think that they are even remotely close to being the same thing. In a financial pyramid, to me, gold is the bedrock. It's the base of your pyramid. Bitcoin would be at the top of your pyramid, the more speculative portion of your pyramid. And that smaller portion of the tip of the pyramid can make you more money than all of the 90% of your investment period or your investment program below. but it is speculative. And, here again, if it weren't, then all the central banks would own Bitcoin, but all the central banks own gold. What they both are, I guess, is freedom from the system, an exit from the matrix. They are tied to each other that way. But to me, they're vastly different. And I think it's not fair to either of them to call them similar or same. To me, they're not.
Okay. All right. Yeah, definitely. We got the people on the panel. The either one of you guys want to ask CEO Schectman a question?
They're shy. Andy.
They're shy. Yeah, sometimes people are shy.
That's okay.
It's okay. All right. Well, I wanted to circle back around. I had watched you on I think it was yesterday, maybe this morning, on Liberty Finance.
Yes, we watched it.
And you talked about a $400 silver price.
Yeah.
In the coming future, and I seen you had did the calculation. So could you explain a little bit about that?
Yeah, so it's coming out of the ground right now at 7-1, and there are a lot of mainstream analysts that are talking about silver being at $3,000 an ounce in 2023. You take 3,000 and you divide it by 7, and that's what you get, $428. So, is it unrealistic? No, it really isn't at all for it to be that kind of evaluation. And I think it's important to understand that when you look at what's happening off the largest exchanges in the world, they're being bled down to levels that no one's ever seen before. The London Metals Exchange just came out and said if demand is the same as it is this year as it was last year, there won't be any silver left in 2023 on the exchange. There's only 33 million ounces backing the registered category of the COMEX, and India imported 300 million ounces this year. They're from the very highest epicenter of all supply. The most sophisticated money in the world is draining it. And so when you talk about the fact that the price is not reflective of demand. And I think that this is one of these deals where the biggest money in the world has been holding down price of gold and silver so that they can specifically take possession of it. Let me make it easier for people to understand, but we'll use it with gold instead. And I talked a little about this on Dunnigan's show yesterday. So it will make a little bit more sense. So first of all, when I talk about how do you suppress the price? So I asked my head gold trader the other day to break it down for me so I could explain it to people. And if, let's see, we'll take these 2 credit cards. All right, these 2 credit cards here, let's say they represent physical gold here, and this one is paper gold, right? So if I have, let's say this is 500 ounces of gold I put in my warehouse, I'll sell 500 ounces on COMEX. So if the price of what's in my warehouse goes down, what I own, it goes up commensurate on COMEX, and vice versa. So I'm always market neutral, right? Always market neutral to the valuation of gold. I'm not speculating with our inventory. So I hedge it, it's called. So I asked him, how much does it cost to purchase a 100-ounce gold contract? And he said to me, oh, the actual trade is just a couple of dollars, but we have to have $6,900 currently in our margin account. So if we have $6,900 in our margin account, when I asked him this last week, that controlled one 100-ounce gold contract worth $187,760. Well, imagine if you're a commercial bank and you have $500 million in your margin account. You can create whatever perception of reality you want by going long or going short on paper at a leverage of 27 times. Every $1 spent is worth 27.2 times leverage right now. So the big banks, the very large commercial banks, for a very long time have been suppressing gold and silver because they are the canary in the mine shaft. But what's happening right now is that as they are suppressing the price, the danger in that is that these exchanges allow for delivery. And if you're going to go short, you're going to sell something short. That means you get paid money. You must pay it back. And if the person who has the other side of that contract wants it delivered, now you're in big trouble if you don't have access to it. So right now, there are many, many, many times more paper contracts than there are bars in the exchange, and it becomes very dangerous. Last week on January 11th, last week, in one day, one person bought 1,223 spot gold contracts. When you buy a spot gold contract, that means you're buying it for immediate delivery. A few days later, they bought another 505 contracts. The 1,223 are worth $229 million. The 505 worth $96 million. In 2 days, one person took delivery of $320 million worth of gold as these banks are suppressing the paper price and making everyone just look at what the equity markets are doing, what the bond market is doing, what the crypto is doing. They don't notice that price is being suppressed with tremendous leverage by monster money. And at the same time, they are bleeding down the exchanges to the lowest levels they've ever seen. The London Metals Exchange has the lowest amount of silver on it in the 140-year history of the epicenter of metal in the world. The COMEX has 33 million ounces backing, and everyone talks about the drawdown in COMEX silver. COMEX gold, there was almost twice as much gold on a percentage taken off the exchange in 2022 as silver. The biggest money in the world is using the suppressed paper price to accumulate all of the physical, and it's all moving eastward. And it's a really big deal where the central banks of the world bought more gold in 2022 than in any time since 1967. So you have to go back 55 years to find a time where central banks accumulated more gold and silver. And this is because the end of the dollar system is upon us. And for those people who doubt that, I would encourage you to read or listen to all of my podcasts that I've talked about for a very long time on the Brics nations and on Saudi Arabia leaving the dollar peg. Since 1974, every country on the planet has had to own dollars to buy oil. That was the deal we struck with the Saudi kingdom. And there are a million reasons that I've talked about ad nauseum before anyone else in the country has about this ending. Well, yesterday, and this is on Bloomberg, you can Google this, yesterday on Bloomberg, Saudi Arabia is open to discussions about trade in currencies other than the US dollar, according to Kingdom's finance minister, Bloomberg reported on Tuesday. They are leaving the dollar. They are joining what will amount to 85% of human population on the BRICS, which is Brazil, Russia, China, India, South Africa, the BRICS Plus, which is about 50 countries, 154 countries on the Belt and Road Initiative, representing as it is about 75% of human population. And the Shanghai Corporation Organization, you put them all together, you have between 80 and 90% of human population that is not moving away from fossil fuels in the combustion engine and has already accepted Saudi Arabia's application to join the BRICS nations. So Saudi Arabia is joining BRICS. Every one of the OPEC producing countries, all 13 of them are on the Belt and Road Initiative. The US is nowhere near any of this stuff like that. When they come out and say we are no longer taking dollars specifically for oil, like that, it's over. Every company on the planet will dump dollars. And as the dollar gets dumped globally, it creates a hyperinflationary tsunami that goes across the Atlantic Ocean and hits our shores. And when that happens, interest rates have to spike to compensate for the loss of purchasing power, which then inversely is correlated to the value of stocks, bonds, and real estate. They all collapse as interest rates spike. It's the Great Reset. This is why you own gold and silver, because the end of the dollar as the sole world reserve currency is upon us. And if you watch some of my podcasts that I've done, especially the one with Robert Kiyosaki or the one with Jay Martin, where I go in depth into what's happening with the BRICS nations and the exodus away from the dollar and the consequences of weaponizing the world reserve currency by kicking Russia out of SWIFT, taking their money and doing what we did. The rest of the world says, Are we next? Is this us? Saudi Arabia, China, all of them are dumping dollars. They're selling treasuries. They're not buying them anymore, and they are investing and in a conglomerate of countries that are forming a cohesive unit. The rallying cry is against the Western hegemony, and the glue that will make it work is their admission that their new currency will be pegged to commodities. And this is a really big deal. This is the end of the Western Keynesian system and the beginning of a new system. And when you see Saudi Arabia come out and say that publicly yesterday, it's a really, really, really big deal. And I think people need to understand that. And when you see what's going on here at home, which we can talk about, it's getting really scary. What's going on with the FDIC and the leaked video. I don't know if you've talked about that or seen it, but it's frightening as hell. And I think people, if you are not a contrarian right now, you will be a victim in the end. You will be. Let me talk a little bit, just for the sake of your listeners, about the leaked video that you can Google right now that is from the FDIC. I don't know if you've heard about it, but in November, the FDIC has a group that they call the Systemic Resolution Advisory Committee. And they held a meeting to discuss how the next market crash would occur and what steps would need to be taken to ensure that everyone doesn't pull their money out at the exact same time. One FDIC member said that while the institutions like the banks will notice, they'll soon be able to figure out the implications of a financial collapse, that the general public should not, because that would lead to unintended consequences. And he says you have to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe the people in this room do, the FDIC member said. This is a guy who was basically saying, we don't have confidence in the banking system or the FDIC insurance, and if the banks will figure this out soon, but the people shouldn't because of the consequences. And he goes on to say, I would be careful about the unintended consequences of starting to blast too much of this out to the general public. He says, although institutions don't want to see a huge run on their deposits, they likely will soon, which will bring the need to impose bail-ins, which I don't know, many people don't know what that really means. I'll explain it. People need to understand they can get bailed in, but you don't want a huge run on the institutions. But they are going to be, he said. And it could be an early warning signal to the FDIC and the primary regulators when these things happen. Look, you guys, there's $125 billion in FDIC assets insuring $9 trillion in bank deposits. And here you have the systemic, what do they call it? The Systemic Resolution Advisory Committee saying there's going to be runs on the banks because it is coming. So to put a bow on that and an exclamation point, and when we talk about how little our media tells us about what's important, the second largest bank in the world is in Switzerland. Their name is the Swiss Credit Bank. They are this close to going bankrupt. And it's such a dangerous systemic problem that the Fed just gave them $20 billion, bailed them out as the bank of last resort, and they just laid off 9,000 employees. So when our Federal Reserve in the United States has to bail out the second largest bank in Switzerland in the world, and it's in Switzerland, what does that tell you about the fragility of the system? At the same time, FDIC is saying we can't let the public know that there's going to be bail-ins because we only have a very small amount of money backing $9 trillion in assets. And what are bail-ins? Bail-ins are now you are just an unsecured creditor to the bank. Bailouts are illegal. The taxpayers will not bail out the banks. You will. If you have money in Bank of America and Bank of America goes bust, in Cyprus, they did a $100,000 limit. Anything over $100,000 was used to bail in the bank, to bail in their foolish decisions, where during COVID, the banks were able to release all reserve requirements. They hold no reserves, zero reserves. All the money you give them, they lend out and do things with. And if that goes bad, well, too bad. You can keep $100,000, and anything over that goes to bail in the bank. And if there's anything left over after everyone bails in the bank, then it gets passed out in a pro rata fashion. Most likely will just be shares of a worthless bank. But the bottom line is that the risk involved with being within the system right now is far greater than the return that you are getting. And perhaps this is why we see a front running by the most sophisticated, well-funded, well-informed traders on the globe who are draining in a way that is not easy to do the biggest supplies of gold and silver. And it's not just gold and silver, it's aluminum, it's zinc, it's copper, and it's all moving east. And we are, I think, in the middle of this, yet so few people have any understanding of what's coming because the media isn't telling us any of this. You have to dig, 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 and dig to find it. This is why I call gold and silver wealth. This is why I own it. It is not to get rich. It's because what's coming down the road is really quite frightening as far as I'm concerned.
Okay.
I would agree.
I was going to ask you a question that I've received. I mean, I wanted to ask you a two-part question. If you can go ahead and explain gold being a tier one asset. But I often get asked, people ask me about, what do you think, platinum and palladium and their industrial use? Is it a good investment now? So, I mean, I wonder what your thoughts would be on that.
I wouldn't buy platinum and palladium. You could argue, especially palladium. Look, they're both industrial metals used in catalytics. Palladium is used in unleaded vehicles, platinum in diesel. Platinum used to be the main catalytic for all diesel and unleaded. But in right around 2000 or so, platinum was my whole career, platinum was 2 to 3 to 4 times the price of palladium. Palladium would be 300 and platinum would be 1500. And so all the auto manufacturers retrofitted their assembly lines to use palladium in place of platinum for unleaded catalytics. And obviously you can see the desire to switch that around right now. But to me, platinum and palladium are industrial metals. They do not have the history as a monetary asset the way gold and silver do. I own a very little bit of platinum and an even smaller amount of palladium, and I've been accumulating metal for 33 years. To me, they represent but a very tertiary part of the portfolio. To me, gold and silver are money. Platinum and palladium are an investment. And in a world that seems to be, at least in the West, moving away from catalytics, ultimately, I don't really love it, although the rest of the world isn't. So, I mean, I could make an argument for platinum. Not only is platinum heavily shorted on COMEX telling me that it probably should be much higher in value. When you compare it to gold and palladium, it's the same argument I'm giving you with gold and silver. It is historically out of whack in its relationship. It's 30 times more scarce than gold and it's priced below it. Something's wrong there. So it should be much higher priced, but it's an industrial metal and it doesn't have the history of wealth. But I would own platinum over palladium. Also you have the fact that almost all of it is mined in South Africa and Russia. Both are part of the Brics nations. And, these types of materials will become harder and harder to get. So there is an argument for it. But to me, more relevant is that gold and silver are wealth in a period of time where everything is changing around us. What the definition of money, the definition of wealth, all of these things are going to change as the dollar loses its sole reserve status of the world. It's petro reserve status. And you can see that happening right now. We could talk for an hour about all of the countries that are moving away from the dollar. But the bottom line is, to me, platinum and palladium are an investment that I would dedicate at most 5 or 10% of my metals money towards, at least right now, more so to platinum than to palladium. But gold and silver to me are where not only the value is, but when the world thinks of money and preservation, I think that's where they go to.
Okay. Yes, indeed. Oh, go ahead. Yes, yes, indeed.
So we know that disaster is upon us, right? You've been telling us this for a while. We have been hearing the trending of the potential of a soft landing. And I wanted to get your thoughts on, do you foresee a soft landing? Are there benefits to it? Is it even more disastrous? As far as the results of the coming times, I just wanted to get your thoughts about it.
Well, there's something called the reverse repo market.
Okay.
And what that is, it's a market that the Federal Reserve makes to the banks. When the banks have more money than they want to lend out, they can give it to the Fed, and they will buy their treasuries overnight. It's called a repurchase agreement. This is a reverse repurchase agreement. There's the repo market and the reverse repo market. The reverse repo market is when they have too much in the way of money, and they will give the Fed the money overnight. They'll buy the bond, and then they agree to sell it back to the Fed for a small profit the next day. They do this back and forth and back and forth and back and forth every day, and it doesn't go on the books as a bailout, let's call it, or a loan. But normally the reverse repo market has very, very little amount of money in it, because in essence, it's the banks saying they don't want to lend money out into the system. Currently, the reverse repo market has $2.2 trillion in it, which is a huge amount of money, because the banks are afraid to lend it to you and I. And in the reverse repo market, currently they're making 4.33% as of today, the federal funds rate. There's also 3.08 trillion in the reserve accounts. So there's approximately $7 or $8 trillion right now. Let's call it 5 or 6 trillion money held in the reverse repo, the reserve accounts. Let me explain what that really means, and I'll answer your question, but it's a roundabout way of doing it. If the economy was in such great shape, the banks would want to lend money. They would want to lend it to you in the form of a credit card at 20%. They would want to lend it to you in the form of a home equity loan at 10 or 12% or 8%. They would want to lend it to you in a 30-year mortgage at 7.5%. They would want to lend it to you in all of these forms, which is, by the way, how money is created. When the banks lend money, it is now freshly created. Because what happens is, let's talk about, before the repo market, let's talk about the reserve account, which is, there's $3 million in it. Then we'll talk about the repo market. There's $3 trillion in the reserve account. What that means is the banks, if the Federal Reserve comes to Bank of America or JP Morgan or Wells Fargo and says, I want to buy your US treasuries that you have, they have to sell it to them, and they're obliged to. So they'll sell the treasuries to the Federal Reserve. The Federal Reserve pushes a button and creates the money to buy that. So they create money out of nowhere. They buy the bonds. Let's say you guys are Wells Fargo and Bank of America. Now I just gave you tons of money and took your treasuries. You have two options. You can either lend it out into the public in the form of the things we just talked about. And in doing so, that's how money is created. The Fed pushes a button. They buy the treasuries from you. You lend it out in credit cards, home equity loans, mortgages, tuition, whatever, right? That's freshly money. That's how money is created in the United States, period. End of story. That it's not printed into existence, it's lent into existence. But if you don't want to do that, if you don't want to lend it out because you're thinking, you look at each other and say, shit, it's really frightening out there. The economy is smoke and mirrors. It's on razor's edge. I don't want to lend this out. You have, only other option you have is to give it to the reverse repo, or to a reserve account in your name at the Treasury. So at the Fed. So the Fed is now holding $3 trillion from people like you, the banks. You're a bank. They're holding that $3 trillion, paying what is in essence 4.4%. Instead of the 20% you could get on a credit card, or the 7.5% you could get on a mortgage, or the 12% you can get on a home equity loan. So you see, they're willing to take as much as 5 times less return in the reserve account rather than lend it out into the system. And all of the reserves that the banks themselves hold, instead of lending it out to you and I for those same returns, they do it in the reverse repo market. They give the Fed the money overnight, and then they buy their treasuries, and they do this every single night, earning 4.33% currently, instead of lending it out. So there's $5 to $6 trillion that the banks do not want to lend out into a system because they are afraid of what's coming. So when you ask me, is there a soft landing? The banks would say, no, there isn't going to be a soft landing. And the bond traders, the most sophisticated traders on the planet, are showing you through the inverted yield curve that they expect the Fed to pivot, which means they'll stop raising rates and they'll actually start to lower rates again and do quantitative easing, which means they will continue to inflate away the value of the dollar. There is $135 trillion worth of debt in the system. 30 of it is in our national debt, and over 100 plus in unfunded liabilities like Medicare and Medicaid. 55 trillion in Social Security, government and military pensions, all of that's off balance sheet, unfunded. And a trillion seconds ago was 31,688 years ago. If they raise rates to fight inflation, then all of these obligations become exponentially more expensive, and you see the market start to break. All of the bonds that were sold at 0 and 1 and 2 and 3% now become worth less and less and less as rates rise. So everything starts to break because of the illusion of suppression of interest rates, which has created distortions in asset prices. If they keep raising rates to fight the inflation that they're talking about, it will reach a point where the markets snap and everything collapses, the stocks, the bonds, the real estate. So how do you engineer a soft landing between being tough on inflation or reaccommodating and loosening up your aspirations of being tough on inflation? So in other words, it's either hyperinflation or it's the Great Depression. Trying to find the middle ground somewhere in between will be next to impossible, in my opinion. And at what point do our foreign creditors say, what the hell am I buying a US Treasury paying 4% for when inflation's twice that? Why am I buying dollars and holding dollars when it's being inflated away at 7 or 8% per year? Now that 7 or 8% is BS too, because those numbers, they changed them in 1980. They stripped out food, energy, and housing and called it the core CPI because they want it to fit their inflationary agenda. The real numbers of inflation, if you go to johnwilliamsshadowstats.com, he shows the way that they used to calculate inflation before they changed the metrics. And he would tell you it's 13 or 14% right now. So even if you believe they're lying 7% CPI, earning 3.5 or 4% in a treasury, your negative real return is almost 4% negative real return. If you really understand that inflation is probably 4 times that at 13 or 14%, and you're getting 3.5 or 4% on a treasury, you're going backwards by 10% compounding per year. It is a sticky wicket of epidemic proportions. Either they give in and they get real tough, and you start to see things like entitlement payments, food stamps stop, no more of these stupid payments that they're doing, this 1.75 omnibus bill, trillion omnibus bill, of which $400 million goes to protect the border of Oman and Lebanon, but no money, it says specifically, can go to protect the US border. The stupidity of this government is doing will allow for a soft landing. And I would argue that inflation has peaked for a short period of time. But the one thing that I am fairly certain of is that we are not going anywhere near 2%, maybe ever again. And I don't think investors understand that. I think the days of low inflation are over, and the recession that everyone denies even exists is actually going to get worse. And the only reason things look a little bit better is because our idiot president depleted to 40-year lows our strategic oil reserves that are supposed to be used in wartime for an emergency, and instead he used it for political gain. And so you can see that is even remotely possible. When this all plays out, it will either be a inflationary nightmare, or it will be they raise interest rates so much that everything collapses, everyone loses their jobs, and you see mass defaults, the housing market collapse, the bond market implodes, the stock market collapse. That will happen if rates rise high enough. So where is the soft landing? It's just a bunch of crap that, just like we were told that there is no inflation, and then it's transitory, and then it's structural. And I mean, they've been lying to us forever, and they're still lying to us. Just like the FDIC is lying to us when they admit in their meeting the public can't know about this because they'll make a run on the banks. They're lying to us, whether it be by omission or whether it be flat out lying. They're lying to us. So no, I do not expect. And look, I started doing this long before things ever got really scary. And I started doing this with one vision, that gold and silver were wealth. I never spoke ever about doom and gloom, but the path that we are on is a frightening one. I have 3 young children, well, my youngest being 15, and I'm afraid for the world they're growing up in. And I truly am. And I do not think that a soft landing is in the cards. And this is what they want you to believe. As the biggest money in the world drains the physical supply of metals around the globe, which is the antithesis of the dollar, you can see, do not do what they are saying, do what they are doing. And that would say, no, no soft landing, especially when you see every time the market goes up, you see record insider selling. The people who own the companies, they're selling, they're leaving, and the public will be left holding the bag as they always do.
Well, I wanted to pivot. I'm gonna pivot a little bit. I just had a question about a strategy that we like to employ. So we have four sons, ages 21, 15, 12, and 5, right? And so what we say is we buy silver for people who aren't here. I assume that we're gonna have grandchildren, and so we're buying for the grandchildren. And then I tell my sons that you buy for your grandchildren. And that's just something we've been employing, and just to try to build the generational wealth. What would you think about that?
I think you're smart as hell. And I think that very few people understand the concept of savings and paying yourself first. And I don't think there's a better way to save for future generations than what has been recognized as generational wealth for all of time. Especially when you're talking about your grandchildren. I think they will inherit silver that's worth a whole heck of a lot more than it is now. I think that is really smart, because you hold an ounce of silver in your hand. It takes a modicum of effort to sell it. You want to go buy yourself, whatever it is that you want to buy. You can pull out your credit card, or you can, take cash or send a wire or a check or whatever it is. It's easy to spend money, but it's not as easy to liquidate your precious metals. It takes a modicum of effort. And when you talk about what silver and gold represent, not only is it intrinsic wealth that has been valued that way by all humankind forever, it's also sentimental. My grandfather saved for me for this, and specifically told my father that this was for me someday, and that it is my job to do this for that's sentimental, that's heavy. You're not going to go blow that on a pack of baseball cards or a movie or whatever it may be, when you realize that your grandfather 50 years ago put a lot of thought into me. And I wasn't even a thought in my father's mind at that point, but my grandfather thought enough of me to save for me. That's heavy as far as I'm concerned. So yeah, I think that that is something that I think makes you very smart and ahead of the times. That's for sure.
Okay. Well, so we didn't want to keep you too long. I got one more question that I seen you on the I believe Liberty Finance. You were talking about investing, the premiums of the American Silver Eagle, but you were talking about it was a good time for like the Philharmonics, the Cougarans, the Maple Leafs, what else did we have? The Britannia, and you were saying that it's a good time to invest in them.
It is. And I think just about anything besides US Mint items. I am a US Mint authorized reseller, one of only 27 in the world. And the US Mint in many ways has defined and shaped my career. And I'm very appreciative of them, but their products are ridiculously overpriced. I think there are far better values. And those 5 mints that you mentioned, United Kingdom, Britannia, South African Krugerrand, Austrian Philharmonic, Australian Kangaroo, and the Canadian Maple Leaf, all have been stupid priced too for the last 2.5 years. Right now, for the first time in the better part of 36 months, are a good value. Yeah, you can buy all of those coins, not much higher than they used to be priced in 2019. I would not buy Eagles at this point. And mind you, I don't think premiums will stay at these levels for long. I think they'll go right back up. As I mentioned, the reason for that, you had the 2023 allocations come out, and they usually come out in November, December, along with the fact for the first time in 3 years, people go out and visit their family without restriction. I mean, I know I wanted just to completely unplug over the holidays. After being bundled up and locked up and caged up and bound up and freaked out for 3 years, people just wanted to unplug and go see their mom and dad and their grandparents and see their kids and go enjoy a vacation without wearing masks and worrying about getting sick or stuck in a foreign country, because you don't make it back in because of COVID protocols. And so I think that had a lot to do with the slowdown in demand, coupled with the increase in supply, has given rise to what is the best environment premium wise we've seen in 3 years, and availability the whole industry has seen in 3 years. So yeah, they are good values right now. I don't expect it to last very long. I really don't, because there's less than 0.5% allocation to precious metals across the whole United States financial matrix. And when people wake up to what's coming, I think that they will look to gold and silver as the only place to put their money, and bang, it just disappears like it has been for the past 3 years. It's been incredibly difficult to find and to keep stocked. So good values to be found right now, that is for sure.
I got another question. I got questions for days, but I heard you talk about we always tell people to diversify their silver portfolio, and I heard you talking about I call it constitutional silver. I guess it's junk silver. The value of having things like that, and so that you can it has some diversity as far as if you need to liquidate it.
Yeah, well, the reason people buy the constitutional silver, amongst others, is its utility, its versatility, where you have 14 dimes minted prior to 1965 is almost exactly 1 ounce of pure silver. So in that example, you'd have 14 transactions if you ever had to trade or barter, whatnot, versus a 1 ounce silver coin where you have one. There are a lot of people who really prefer things that are American minted, as it pertains to what could happen if there was ever a future confiscation, or I don't. That's not why I would do it, but there are people that do feel that way. Bottom line is that pre-65 constitutional silver is the most flexible way of owning silver. It gives you the most utility, the most options to trade with or barter with or whatnot.
Okay, well, we kept you a little long, but I mean, we chopped up some good game. That's what
It's
we want.
okay. No, I love being here with you guys. I'm happy to come back anytime and
Oh yeah, yes. But
keep doing this on a regular basis. I'm more than happy to help you.
yeah, tell the people like where we can find you. We're gonna put everything in the description, but as we've been sending people your way to purchase silver,
To get started,
yeah, so let
especially.
us know.
And also, Andy, I want you to emphasize how personalized the experience is when they contact Miles Franklin, how you guys go out of your way to really help them understand how to get started, the best ways they should move and purchase, and so on and so forth. And also tell them you've never had a complaint.
We have never had a complaint in 33 years and 8 billion in sales. Our new website, which has been a huge, colossal, awful embarrassment for me, where we've just had one misstep after the other, is almost done. I mean, it is basically done. The only piece is we're putting in the Avalara tax software. There's a half a dozen states in the country that charge tax, and it goes down to the counties, and it's fairly in depth. We're a week or two away from launching it. In the meantime, and in any time, will always be a hybrid model, and people should send us an email at info@milesfranklin. Say Aaron sent me, and we will make sure that they get the best price in the country. And what I'd really like to do, and we should talk about this, is to give back a portion of every one of your clients that purchase a portion of that sale to you guys, so you can continue doing what you're doing to educate, and maybe my way of giving back to your grandchildren as well. And I know you're in Mexico, so that becomes a little bit more challenging, but certainly sending silver to your residents in the United States would be much easier than sending it to Mexico. Unfortunately, sending metal to Mexico is very difficult for us. Anytime you go south of the border, it's difficult. I have an easier time sending silver to Canada or to Australia or to the United Kingdom than I would to Mexico. The insurance companies have a hard time with that. But for your listeners, send us an email, info@milesfranklin. Ask for a current price list. Ask any questions you have. Ask to be contacted. Give us a phone number. Say Aaron sent me, and I will make sure that my brokers or myself not only promptly answer the questions, give them that great experience, answer their questions, and make it all around a very, very good experience. That's something that we're good at doing.